So 1974, we went from everything looks okay to the worst recession since World War II in 4 months. I'm thinking it's going to look similar because of the speed of the monetary tightening, the speed of the rise of prices. So I think we are going to have a very ugly few months, both economically and for markets. The question is what comes next? And that's the key point.
Raoul, the founder and CEO of global macro investor and famous author of Rich Dad, Poor Dad, Robert Kiyosaki, warned about, we are going to have a very few ugly months of financial crisis. Raoul expects that the recession will happen in a matter of months, similar to 1974. With the latest inflation figures coming out at a historical 9.1%, Raoul explains his macro outlook on the economy and how he expects things to play out moving forwards. He also explains his opinion about the timing of a recession and what the Fed will have to do to keep the economy from dropping into a depression. Here's more of what they had to say.
If my base case comes into play, which is the Fed pivot, they stop raising rates. They already started suggesting maybe we'll pause in September. My guess is June will be the last hike. And after that, they will say, well, we're just going to see, and we'll see the economy start going down the toilet. And they will start thinking, well, we're not going to do QT now either. So they're not going to start shrinking the Fed balance sheet. And before you know it, we're going to be talking about rate cuts, but we don't have many rates to cut, rates are nowhere. So the only outcome is they're going to have to print money. The credit markets are already starting to dry up. That's usually an indicator. The housing market's rolling over.
Printing money is this stuff here. You have silver coin, you have a copper coin made silver, right?
That's right.
Basically, and it's called debasing the currency, which the Romans and Chinese already did.
Yeah, because don't forget, the debasement of currency works in a simple way. If you're really thirsty and I have a bottle of water, you'll pay anything for it. If you're really thirsty and I've got 5 bottles of water, you're kind of thinking, yeah, I probably need some of that water, I'll buy them all, but at a lower price. If I say, here's 1 million bottles of water, you don't want any of it because there's too much water now. It has no scarcity. So if you make too much of something, it becomes less valuable. So if Da Vinci had created 50 million pieces of art, guess what? They're worthless. And so it's that concept. And what it does is, if something gets devalued versus something else, so we're not making more shares in the S&P, actually what we're doing is buying them back, making less of them. Therefore, the S&P goes up. Real estate, yes, there's periods where we try and create new real estate, but generally real estate prices go up versus the Fed balance sheet because it's a relatively scarce asset. Same with gold, same with crypto. So that's the phenomena. It depends how fast they deploy the balance sheet, because this balance sheet magic optically changes markets. And if markets go up, then household net worth stabilizes and spending comes back. Companies stop laying people off. So it's actually a bit of a magic trick.
It comes down, that old saying, the bull goes up the stairs, the bear goes out the window.
Yeah.
So, but the bear is about to go out the window. The question is, when does the bull start climbing again, right? Is it kind of what
right. And we either go through a scenario like 2000, which was a typical old school recession where, equity markets, unwound excesses, the bear market was 18 months or so, and then the Fed keep cutting rates and eventually it stabilizes. But if we look at 2008, which was the next recession, as soon as the Fed used the Fed balance sheet, we pretty much stopped in its tracks. Happened really quite quick after they did that. They cut rates first, didn't really help because the banks had seized up. Then they used the balance sheet. Then they did it again in 2010, 12, 16, and then 18 was the Fed pivot, the Powell pivot, where they went from hiking to, oh my God, we need to cut.
Right, and Trump yelled at the guy. He says, you cut this out. You're killing my economy.
That's right. So inflation had gone up.
Yeah.
But Powell I need to do this, but the economy cannot take higher rates because everybody's so in debt and everybody's so old. That is the problem.
So here we are, 2022, right? We have employers not going back to work. So all these REITs, REITs, real estate investment trusts, they own all these office buildings. And then never has the Fed has I think there's a $30 trillion debt now with $200 trillion off balance sheet. and they keep cutting rates and all this. But my
Is-
question is, can they keep doing the same thing given the conditions
so
of
this
today?
is going to take us back to the 1940s in a sec, but you're going to get destroyed because of the supply chain issues, because of COVID and all of this, and your wages won't keep up. So we're going to destroy household net worth, and everything's levered. So all the borrowings against houses and all the borrowings against equities and all of the borrowings on top of borrowings, and you're going to let the collateral go down and blow the entire thing up.
But isn't that what they're doing when they say they're going to pay off the student loan debt?
That's
Creditor.
debt forgiveness, that's MMT, right? Which is coming, whether we like it or not. So what they're trying to do is reduce the debt via financial repression, which is you basically have inflation running slightly higher, so you have than interest rates. So what you want is to reduce the real value of the debt. So if you think back to your parents, how much they paid for a house and the mortgage they had, the mortgage seems laughable. It's because over time, inflation raised the value of the house and the debt doesn't get raised. So in the end, the debt is nothing. So
the way that is this stuff here make the money less valuable.
correct.
Oh,
It makes the debt less valuable.
right.
So it's okay if you're in debt, but if you're lending money, it becomes complicated. But anyway, the point being is you either have a fiscal stimulus, which is, let's say, the Republican view. We'll have a fiscal stimulus, cut taxes, and we'll put some spending. And what happens is that doesn't go to the people who are the worst off. So it's creating this issue of 1% versus 99, which everybody can see and nobody knows how to solve. The issue is actually the balance sheet, because all of the expensive assets keep going up because they keep
Right.
printing money, the rich get richer.
Yeah.
But doing this blanket fiscal stimulus is hard because the rich get richer again. So I think people have thought, well, maybe we should just try and give it directly to the people who are most affected. Okay, fine. Those are the two choices, or you do nothing, which is too late because there's too much debt. So you can't let the system clear anymore. The old way would have been you let the system clear, it's all okay, you just have a recession, everyone stops borrowing as much money, blah, 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 blah. The world is 400% of GDP in debt. The world has never been this in debt in
Right.
all economic history. Let's go back to the 1940s now and figure out how bad it was then. This was the very similar setup, the worst supply chain issues, massive inflation, everybody coming back in. Well, what happened was the economy collapsed. Then interest rates came down and they stabilized. And they stabilized because the Fed stabilized them. And inflation was running slightly hot, 3%. And bond yields were about 2%. So real rates, meaning you in the property market, are going to make a lot of money. So negative real rates become very good for assets. And what happened in the 1940s and 50s was a massive economic boom. What we actually got was the value of the war debt eroding because of this financial repression. We had the value of assets like housing. The equity market went up 900% over that period of time. There was a lot of fiscal stimulus because you had to rebuild after the war, and companies were building factories. So if you think of now, companies are going to be rebuilding factories in the United States or in Europe and not in China. So that's going to add some stimulus. Yes, the jobs are not there. It's robots in the factories, but it's still stimulus for the economy. The government will do some stimulus, as we've talked about. Interest rates will remain relatively low. Inflation will remain controllable, but a little bit higher than it has been. And what that sets off is a period of stability and boom, because there's so much technology. There's a lot of big things happening in the world that could be. So that would be my rosy outcome, would be that. And I think that is still my highest probability, that we kind of muddle through this in a way that we don't expect, because it feels like the end of the world. Imagine what it must have felt like in 1948. All you can see is the end of the world. And then you get this massive inflation. You just think this is the worst thing that could possibly happen. What actually came out of it was something very different. It was the rise of technology. It was the rise of, the US as a big superpower. It was a rise of the rebuilding of Europe, the rise of Japan. It was an incredible period.